Good evening, ladies and gentlemen, and welcome to the Q1 FY26 earnings conference call of Tata Chemicals Limited. Please note that this conference is being recorded. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then zero on your touchtone phone. We have with us today R. Mukundan, Managing Director and CEO, and Nandkumar Tirumalai, Chief Financial Officer of Tata Chemicals Limited. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. I now invite Mukundan to begin proceedings of the call.
Thank you, and good evening, and welcome everyone to our Q1 FY26 earnings call. I'll start the discussion with a brief overview of industry, then our operational highlights across business and geographies. The market conditions remain fluid and balanced. Overall, global demand is estimated to be flat in the near term due to uncertainty associated with some of the trading issues. The market condition remains steady in view of demand being stable in India, China, and some parts of other regions, including, I would say, Americas, excluding USA. Though demand-supply balance continues to be balanced, there are uncertainties in tariff with the consuming industries, which will continue to weigh in on market in the immediate term. And as this uncertainty disappears, we could begin to see some more balanced approach to market growing. All soda ash market continue to be oversupplied with high inventory levels in most regions. China inventory remains high at 1.8 million, a slight increase over prior quarter. This is going to continue to keep the market pricing range bound. In India, the soda ash list prices remained unchanged. On an average, import prices remained range bound between $230 to $235. Although MIP has been extended, it has not had much impact on prices. In US, the export pricing to Asia continued to be under pressure and now has reached a balanced number. Overall, we expect pricing to remain in similar level at least for next 6 to 9 months. In terms of company's operational performance, company reported Q1 FY26 on a consolidated basis, revenue from operations of 3,719 crores, an EBITDA of 649 crore, and a PAT of 316 crores. For Q1, the standalone revenue of 1,169 crores had an EBITDA of 270 crore and a PAT from continuing operations of 307 crores. In India, the performance is higher compared to previous year, mainly due to higher volumes, operational efficiencies, partly offset by a minor drop in realizations of soda ash and bicarb. Quarterly sale volume of all products increased, including FOS, to 869 metric ton as compared to 614 metric ton in Q1. US overall, both export sales and prices were marginally lower. The export sales impacted by a spillover of the shipment to next quarter. In UK, the cessation of Lostock operation led to a lower volume, and the other parts of the business which are continuing had better financial operation. Kenya saw slight lower volume, however prices were maintained as that of Q1 FY25. Rallis saw an overall growth of 22%, a volume growth of 9% and price growth of 13%, driven by growth in crop care and seed business, and EBITDA margins stood at 16% and a PAT growth of 100% in Q1. In conclusion, we remain focused on ensuring that we focus on customer delight and serving our clients well. We continue to focus on ensuring that we deliver on our outcomes in terms of volumes, costs, and working capital efficiency. With this, I close my opening comments and hand back to the moderator to open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question and to limit their questions to 2 per participant. You can rejoin the queue in case of further questions. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question comes from the line of Nitesh Dhoot from Anand Rathi Institutional Equities. Please go ahead.
Hi team. Good evening, and thank you so much for this opportunity. So, my first question is on, you mentioned in your opening remarks that on the presentation that prices continued to weaken during Q1, and the overall global demand is also estimated to be flat in the near term. So, if you could give some color on the extent of the price decline that you've seen in Q1 and Q2 so far, and what would that mean for company profitability going forward, region-wise, if possible? Given that India has some benefit of MIP till December, but for the other regions, how is it likely to play out?
So firstly, MIP has had no impact. So let me just highlight. So the changes in the pricing has been fairly range bound. It has been between $3 to $5 at best. In some pockets, it may be $10, but that's the kind of reduction we've seen in most domestic markets. What we have seen is, and if you take a trailing quarter basis, this would be very marginal shift in terms of $3 to $4 between last quarter to this quarter. And we believe that prices have more or less bottomed out. It's going to remain in this broad range.
Sure. And so sequentially, the India business and even the US business witnessed a decline in volumes. So what exactly drove the improvement in profitability, for both these markets? If you could just give some color. And I understand, I think prices you mentioned in the opening remarks. Yeah, please go ahead, sorry.
The US sequentially, I said, is a spillover, so that 50,000 ton would catch up in the next quarter. It is just a shipment timing issue. It has nothing to do with, India too, we see no major issues. We should be clipping around the numbers we've had in the previous few quarters.
Right. So just one last thing. So you had planned a structural EBITDA improvement of about 600-650 crores through shutdown of loss-making UK assets and volume ramp up in India, Kenya, and the cost efficiency initiatives that you mentioned about. So do you hold on to your outlook for FY26 considering some softening further on the soda ash pricing there?
Yeah, so let me clarify. I think while prices are softened, also the input variable costs have come down by almost the same number. That is why the numbers are holding. So I did not speak about the cost side. But having said that, I think our number, which is broadly what I indicated, was 600 crores, split equally between reduction in let's say, unviable operations in UK, 200 odd crores in terms of additional bottom line contribution from new projects getting commissioned, and another 200 crores in terms of cost improvement, I think still hold fine for the full year.
Great, sir. Thanks a lot and wish you all the best.
Thank you. Our next question comes from the line of Vivek Rajamani from Morgan Stanley. Please go ahead.
Hi, sir. Thank you so much for the opportunity and congratulations on good set of numbers. Just wanted to dig in a little bit deeper on the previous participant's question. If you could just give a bit more color on what's driving the sequential improvement in both India and US, given that the volumes are lower, but the profitability seems to be a lot more stronger. Any specific reasons for that? And that's the first question. Thank you.
See, as far as US is concerned, the main driver of the shift is one is the volume mix. I think there's a greater share of domestic sale versus export sale in this quarter, but that will correct itself as it goes into the future quarter, because the shipment which got delayed was mainly because of the issue on export consignment. So the net realization and net margins have been higher because there's a higher proportion of domestic. So it's a mixed issue in US. In addition to that, they've had a lower fixed cost, so that has led to the overall improvement in the EBITDA. And India is purely a volume-led change. The fixed costs are more or less in line. There's a marginal increase, but that was expected because new capacities were coming on stream.
Sure, sir. Thank you so much for that. So just a clarification, given your opening remarks where you said that, there's not been any significant changes in pricing, some minor guides. Would it be fair to say that the Q4 EBITDA numbers for both India and US may be the more normalized numbers going forward, or the 1Q numbers should be more of a normalized benchmark, assuming no significant changes in pricing?
So broadly, I think in US, as I mentioned, the mix will normalize. So because of the mix, there is probably going to be in quarter two, because quarter two will have higher share of exports and lower share of. I think you would see that getting into a zone which is slightly lower than this quarter. In addition to that, there will be some additional costs in terms of fixed costs. So I think US should tend to drop a bit because of the two drivers, which are basically export domestic mix versus and the maintenance and fixed costs there. So that's really the driver there. As far as India is concerned, we do believe that it is going to remain range bound, more or less what we are clocking. We may not see any major shift. If at all there's any big shutdown which is coming, it is in Kenya, but we have enough stocks to serve the market. The quarter two.
Great, sir. Very clear. And just the last one from me, given the recent news flows that the Chinese government is looking at the excess capacity that's there across the petrochemicals and the chemicals landscape. So I just wanted to hear your thoughts if you think that could, drive any kind of benefit from a soda ash perspective. Thank you very much.
So all we are saying is there have been efforts by several governments. Chinese government is trying to do its piece. Indian government has put MIT, but in terms of market behavior and market condition, if we see an early sign, I will report back next quarter.
Yes, sir. Very clear. Thank you very much, and all the very best.
Thank you. Our next question comes from the line of Saurabh Jain from HSBC. Please go ahead.
Thank you for the opportunity. My question is on the UK business. We saw that the margins have kind of improved sequentially, obviously because of the product mix that has become favorable for now. But wanted to know your sense whether the current run rate is what something you expect to continue for the rest of the year, or there is more room for improvement in terms of profitability and EBITDA that you deliver.
The UK, I think there are two big drivers of the shift which will happen. I think the quarter one, they have had to buy CO2 from market, so their in-house CO2 production should start this quarter. Secondly, the pharmaceutical grade salt plant has been commissioned, but right now they are going through a process of qualification with customers that should begin maybe in the second half of the year. So I think there will be two further drivers to move. We do expect to run the year towards the third and fourth quarter with at least balanced or zero losses at the PAT level in UK. So I think the drive is towards that, and the two drivers of that are fundamentally the shift towards own CO2, which is obviously lower cost, and also sales and approval of pharmaceutical grade salt from the customers in the second half.
Okay. Any numbers that you can share? How much of savings are you targeting from this in-house CO2 captive plant?
We can't give specific, but I already sort of highlighted that we do expect that the 31 negative which you see should disappear.
Okay. Thank you. And what happened to the Kenya margins in this quarter? It kind of saw a big decline sequentially. So any light on that?
I think fundamentally the sale of the proportion, the mix of sale in the local African market had reduced. That should be back up as we move through the year again. So whenever they export more towards Southeast Asia versus domestically in Africa, I think the margins tend to shift. I think that would be back to normal.
Okay, understood. Separately, there is a comment in the presentation that the PAT includes a 75 crore on account of income tax refund. Where is it reflecting, and is it in the India business?
That's an India business there, both in the other income line, interest, and the tax line.
Okay, but what is it relating to?
So we got income tax refund order in the month of May towards the old case we had that was in our favor. So that came in the month of May, and we got a tax order for refund for both interest and tax. Yeah.
Actually, we had also informed the stock exchange
in the month of May.
In the month of May. If you look at the notice released by the company, the details are there on the stock exchange.
Yeah.
Thank you. And one last question: what is the progress on the Kenya capacity expansion? What is the update there?
Yeah, I think that's what I said. We have commissioned a 50 kiloton calciner, and it is going through what I call as the trial runs as we speak. So sometime during the second quarter, it should be delivering products towards the market. But we will clarify that specifically with more color in the quarter two. But it is being commissioned. It's going through trials right now.
Okay, understood. Thank you so much.
Thank you. Ladies and gentlemen, we request you to please restrict yourselves to 2 questions per participant. You may rejoin the queue for follow-up questions. Our next question comes from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah, good evening and thank you. The sharp decline in power and fuel cost this quarter on a quarter-on-quarter basis sequentially, is that primarily led by lower coal costs, or is it the UK closure? If you could please help us understand.
Yeah, it is a combination of the two. It is also led by lower gas, lower coal, and also cessation of the operations.
Okay, so this is a sustainable number going forward, right?
Yes, this is a sustainable number. And also, there could be savings because some of the optimization work is yet underway. So that's where we are. But should be sustainable.
Thank you. And just on the UK expansion, the turnaround. There was this sodium bicarbonate project that we had planned. So is that still on track? And if so, by when could we expect it?
So we are going through right now. This is the design work is still continuing, and as we speak, we are continuing to progress that. But our first effort during the current year in terms of the needle is to make sure that we get at least we end the year at a break even at the PAT level. That's what we are working towards. We're making sure that all the projects commissioned and all the existing capacity of bicarb is back on stream in a balanced way, because they had to reconfigure the unit because it no longer has a soda ash unit attached to it. They're also going through qualification on the pharmaceutical grade.
Sure, thank you. Just one suggestion from my side. I believe previously we used to offer the geographical split of the US volumes. I'm not sure I see it anymore in the presentation, but it would be helpful if we could start getting that again once again. Thank you.
Thanks for the suggestion. Noted.
Thank you. Our next question comes from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, so my question is for India, and we have seen a EBITDA improvement. So is there any kind of the revision of the contract for soda ash which is helping us the margin improvement, or a benefit of any input cost, or sales salt business has better margin in this quarter?
All in all, I think the variable costs are down per ton basis because there's been highlighted by several speakers, several analysts. The coal prices have come down, so that is certainly helping us.
We can't hear you. Can you speak closer to mic?
Is it clear now?
Yeah.
So I said, as has been so you're getting an echo from your line.
No, okay.
Yeah. So the variable costs were certainly lower. You're still getting an echo from your line.
Sir, you may proceed. Yeah. Go ahead.
Okay. So, as I was mentioning, the variable costs are certainly lower on account of coal and other input costs. Also, the higher volumes and in terms of pricing, as I mentioned, it is range bound. In some pockets, it's dropped a little, but it's thereabouts. So the real driver of this number is really higher throughput and making sure that our fixed costs are more or less even Stevens and in line with what we had budgeted. So it's basically variable cost and volume.
Okay. And can you talk about the capex for this year and capitalization for capitalization also?
See, last year we had the peak capex cycle on account of the expansion in India. That's now over. What's going to be this year is only the operational capex for all geographies. And roughly around 1,000 crores we incur every year on the operational capex. Not much growth capex left to pay. Everything is done last year.
Capex this year.
Yeah.
So what is the maintenance capex?
What is that?
How much maintenance capex this year?
Around 1,000 crores you can say for the full year across the globe.
Maintenance capex.
Yeah.
Okay. Okay. And anything about US soda ash expansion and bicarbonate we were discussing earlier?
As of now, I think we are continuing to push ahead with the expansion and growth in Kenya. We will certainly be looking at opportunities for growth in India also. The next phase of growth in Mithapur is being worked out. We'll come back with specific number towards the third quarter of this year. While the design work in US is continuing, we will press the pedal on that only when the market conditions seem to be clearer to us. As of now, we put it on a pause, but it will be a pause for either a couple of quarters or maybe a year. But the moment market conditions are clear, we would press ahead. So the work is continuing. The approval from the environment authorities, public hearing approval has been obtained. So it is pretty close to getting all the necessary approvals. But it's internally, we are awaiting the right time to press the green signal.
Okay. Last soda ash side is demand supply scenario and balance. And going forward, do you think in next 2 to 3 quarters we can have some balance soda ash demand supply, and any sense on that? Any timeline when we can see some the tightness in the demand supply in soda ash?
Yeah, this is the current situation we are facing. There's not a demand problem. Demand is actually very fine. The demand is growing as per our projection. There is no issue at all with the market and the demand side. Our issue is more from the excess supply and the continuing operation of unviable units. If you look at the ceasing of operation, only 2 people have announced their announcement. One is us, and also the other second largest player in Europe has also announced ceasing of one of his operations. We've just heard some news of a Chinese unit going into long maintenance shutdown, whether it is ceasing operation or this unit is Shandong Haihua, which is considering idling capacity. But we'll have to see as these announcements come. So actually, the big issue in terms of the needle moving will be on the basis of either plants idling capacity or taking a pause for a certain period of time till the demand catches up. Right now, it's not a demand issue; it is fundamentally a supply issue. Buy some units which are unviable.
Okay, thank you.
Thank you. Our next question comes from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Good evening and thank you very much. So, if you look at the China prices, so they're at about $160. So, to what extent is the market in Asia already discounting the entire excess supply from the Inner Mongolia expansion, or is there still some more increase in production from Mongolia which can put further pressure on Asia prices?
So it's really Mongolia expansion has come on stream, which we knew. But I think the real issue is that at these prices, many of the units in China are not viable. So I think that there'll be some movement which needs to happen there. So really, the Mongolian unit is fairly competitive. It's a natural soda ash. It is really the synthetic soda ash which you have to take the call. We'll have to watch the news flow.
So is the entire Mongolia capacity in operation now, at 5 million tons?
Yeah, more or less.
Okay. So in terms of the P&L now, can you give us some sense in terms of the sustainable run rate for depreciation, interest expense, and tax rate, particularly with reference to UK, because there you have taken out one asset for the Lostock facility. So if you can put these things in perspective for UK as well as the company, it will be useful.
Yeah, I think if you take the current quarter number, more or less it will be somewhere around 5-10 crores around that number in terms of depreciation amortization. And finance costs, depending on how quickly we can start to pay down debt, we will make some effort during the year. It will start to also go down, but the run rate mentioned in the current quarter should be what one should expect during the year.
And what about the tax rate?
The current quarter has those tax refunds, Ramesh, therefore we can't generalize that. So, I mean, it will be depending upon the full year's profit numbers, what comes. This current year, so we can't take the Q1 tax as for the full year. It's got a number of one-offs.
Okay. And so if you were to dwell on the UK business, the EBITDA margins have improved. So in terms of the run rate, say over the next 3 quarters this year and then FY27, would we go back to the British Salt gross margins and EBITDA margins? And when you ramp up the pharma business, do you think that entire volume can be placed next year?
Yeah, I think that is what we expect will happen. So effectively, you will see a quarter-on-quarter improvement in the trend in terms of UK. By the time you come to the fourth quarter, you will know exactly what will be the sustainable numbers or thereabouts as far as UK is concerned. So every quarter will be better than the previous quarter because as we start to stabilize the bicarb unit with the new power configuration and having in-house CO2, that structure will improve. As the pharma salt starts to get into the market in terms of that has a higher margin, so it will start to impact or at least show that in the result. So we expect every quarter it should sequentially continue to improve.
So one last thought on the India expansion, you've seen about 32,000 increase in soda ash on a YOY and another about 12,000 in bicarb. So will we see the entire capacity from the expansion being placed in the second half for soda ash and bicarb, or will it take some more time?
No, the only one which is ramping up every quarter, every month is the bicarb, because as you know, bicarb we have to work with our customers in developing application. So the utilization will continue to trend up. If you say that broadly, I would say about 20,000 tons of that will, the 5,000 tons per month approximately is the amount which we can make up as we move towards the end of the year. In terms of soda ash, there is no issue in terms of placement of the product or market issue.
In spite of the slowdown in auto and the container glass, you don't see a challenge in the Indian markets?
Overall demand, there is India will continue to show higher. Our assessment of the market, at least for the first 2 quarters of the calendar year, Indian market has continued to grow. There's a slight dip in Chinese market by about 1%, and then we anticipate for the full calendar year, market other than North America, which is in South America, will also show growth. And China is a slight dip, India is a growth, and US is flat.
Thank you very much and wish you all the best. Thank you.
Thank you. Our next question comes from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. It might be slightly repetitive question, but I'm just referring to our Q3 presentation where we have given the expansion project pipeline. Soda ash India 3.2 lakh tons, silica 0.6, soda ash US 4, soda ash Kenya 3.5, and bicarb UK 1.8. So given the current circumstances, are there any deliberate delays on these projects? And what are the timelines that we are seeing for all the 5 projects and the overall CapEx as of now, which is envisaged for the same? Thank you.
In terms of, as I mentioned, the design work and the public hearing approval for the US soda ash has been obtained. And so it needs just one more notification to get the full clearance. So the work is in phase, but that is the one which is on pause as we speak. As far as India soda ash is concerned, out of the 320,000 broadly, we are looking at doing it in 2 steps of 150 and 170,000 tons. We'll come back to you by the second, third quarter in terms of the operationalization of that. As soon as the details are clear, but it is going to be more like a debottlenecking at a low cost rather than full expansion as we had thought of before, because we do believe there are headrooms available in balancing capacities to do it at a much lower cost. In terms of UK bicarb, this year we'll be spending time on making sure our current existing 80,000 ton unit is fully run in a proper manner before pressing the pedal. There again, design work is on its way. And in terms of the silica, we are going to do this in 2 phases. The first phase will be half of the number there, which is already undergoing. I think the execution is just about to begin.
Sure. Thanks a lot. That's all from my side. Thank you and all the best.
Thank you. The next question is from the line of Ankur from Axis. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Just a clarification on our US EBITDA, for this quarter. So if I look at Q on Q, given that, large part of the business is contractual, wherein we enter into contract for the full calendar year, I'm just trying to better understand the Q on Q variation here. You did explain on the volume bit because of the delayed shipment volumes were lower. But it is purely because of lower exports that there is a sharp jump, almost 100 crores odd jump on the EBITDA. Is that a fair understanding?
Yeah, I mentioned two factors. One is mix is correct. The second one is a lower fixed cost. The fixed cost may normalize next quarter, and broadly the range you're looking at is about $2.5-3 million up move on that. That's what we think on the fixed cost will move. Fundamentally, that is a second driver which is here, in addition to the mix.
Sure. So from a steady run rate perspective, what should that number be? Let's say a 150 crore odd on a steady state basis, give and take on a quarterly run rate?
We can't comment on that yet. As of now, it's a forward-looking thing.
Sure.
But as you mentioned, the fixed cost,
yeah.
So fixed cost will go up quarter on quarter next quarter because we have some savings in Q, which will come up in Q2. Apart from that, the mix will change in Q2 because of the export being more than domestic. But we can't comment on the exact numbers of what will the run rate going forward.
Sure, no problem. The share of exports in US was around 60% last quarter. What was that number in this quarter?
We'll come back on that.
Look, the export consignment which got delayed to next quarter was about 45,000 tons. That's the indicator I've already given. I think in terms of if you wait for the second quarter result, the H1 will be fully indicative of what the normalized number is likely to be.
Sure, it should be good. Second question on the Kenya side. While the volume run rate is slightly lower versus what we have seen in the earlier quarters, the margin hit is there again. So the volume loss is largely because of the weaker domestic demand. Will that be a fair understanding?
No, not weaker domestic demand. I think it is mostly led by 2 factors. One is, I think there is one delay in the shipments to Southeast Asia, which is not related to any shipment issue, but is a customer asking us to hold back some of the shipments into Southeast Asia, which will catch up during the year. And the second is that half of it is due to the domestic African supplies, which we are hopeful that we will make up during the current quarter.
Okay, fair enough. That's helpful. Thank you, sir, and all the best. Thanks.
Thank you. The next question is from the line of Naushad Chaudhary from Aditya Birla Mutual Fund. Please go ahead.
Thank you. A few basic clarifications, sir.
First, on the soda ash prices in different geographies, just want to check, are different geography prices more or less largely correlated, or do they move in different directions?
So your question is, are they all moving in the same direction or different direction?
Historically, the prices in different geographies
I get your question. Historically, the U.S. domestic tends to be more or less steady, and it is the pricing is linked to only the U.S. domestic market. Indian pricing again is more or less import parity, but there is also the issue of the Indian domestic pricing having a slight premium because of issues related to port and other handling charges and elements. And the true variable number actually is in Southeast Asian market where there is no domestic producer. So really that's the one which gets impacted in terms of the pricing worldwide. So all regions tend to have a localized number. The one which moves in sync with the Chinese price is the Southeast Asian market.
So different prices are fine, but just wanted to understand if everything moves in a similar direction.
Will not, because you see the US and US is on an annual contract, domestic market. So really it will not see any shift at all. Whereas the pricing in Indian market is quarterly, so it will shift every quarter, if at all. And some contracts are half-yearly contracts, so they are not going to move for at least 6 months. The UK market tends to be fully annual contracts, so they don't shift during the year. And Kenyan market or Kenyan exports are mostly quarterly to Southeast Asia, as well as the Kenyan sales to US sales to Southeast Asia are also quarterly, whereas US sales to LATAM is mostly annual.
Again, on the soda ash pricing point of view, what do you think? What can let the prices to drop further? Any possibility going down further from here on? And if it has to happen, what should let this?
So in terms of what we can control clearly is our internal cost structure, which is what we are focused on. And Naushad, in terms of what we have modeled is our realistic expectation. When I mentioned there will be 600 crore improvement over last year, split 200, 200, 200. That is our realistic expectation of where we expect the market to be. At best, I expect maybe a 50 or 60 crore move from what I mentioned. Overall, in terms of numbers, if you put it, not more than that.
Last, on the from an export point of view, how long do you think soda ash typically as a product can travel globally in a normalized market condition?
Can you repeat the question?
Which it doesn't make much. From an export point of view, the soda ash product, how long can it be traveled in normalized market condition, beyond which it's not viable?
Oh, beyond which it's not viable. Fundamentally, for synthetic producer, it cannot travel long because the variable cost of synthetic production is high, and it tends to be mostly domestic or nearby markets. But for natural soda ash players, they have a headroom to travel with a freight cost of anywhere between $30 to $50 odd anywhere in the world, because their variable cost is low.
All right, sir. Thank you so much.
Thank you. Our next question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah, thank you so much for the follow-up. Mukund, just wanted to clarify the previous comment regarding the 600 plus 200 plus 200. So I'm sorry, I couldn't exactly follow what this was. Is this the EBITDA delta that we are talking about for the upcoming year?
This was in relation to what will be the key bundles of improvement between last year and this year in terms of the performance. And I had mentioned that there is, because of cessation of operations in UK, that will contribute about 200 odd crores. The increased volumes in India will do 200 odd crores. And our own cost out efforts which we are doing, both at variable and fixed, would give us 200 crores. That was broadly the comment I had made last time, and that is probably playing out as I expected.
Okay, so 200 times 3, so 600 is the total improvement on a year-on-year basis.
Yes, correct. Which we expect during the year. UK is more or less in the bag. I think in terms of expansion also is more or less in the bag. I think the cost out is work in progress which we are doing.
Got it. Okay, thank you so much and all the best.
Thank you. Our next question comes from the line of Mithil from unlistedindia.com. Please go ahead.
Yes, sir. I had a couple of questions. First, on the natural soda ash industry, it is reported that in China also 2.8 metric tons will come into capacity in next year, 2026 as well. Is that on schedule or? So it's reported 2.8 million metric tons.
Yeah, I think there is an effort to continue to keep adding capacity, but I think we're also watching this space. I think this has to be first looked in the context of whether there's a rationalization of synthetic capacity in China. There is already an effort, and I think we need to watch this. So we'll clarify this to you maybe better than next quarter very clearly where it stands.
Yes, regarding the natural soda ash only, the WE Soda has bought Genesis in the previous quarter, and now they are the leading producers of natural soda ash. Given their dominance in the forward integration to glass also, are they in a position wherein they can keep the soda ash prices lower and still benefit? So the lower soda ash prices are still benefiting them actually.
So, Mithil, I don't understand the question. I'm not going to answer that in the question of a specific company, but generally I want to tell you that when input material prices go down, for a downstream manufacturer, it is actually negative in terms of competitive advantage because his competition gets the raw material at a lower price. So, broadly, let me leave that with you. I think that should give you where I think if you are a downstream product producer, you would want the raw material actually for your competitors to be priced higher.
Okay. Got it. So the second question was on coal prices. They have risen from May. So we have seen a sharp reduction in coal fuel cost this quarter. So can it possibly go up in the next quarters?
We are constantly contracting, and our numbers are not tended very much up. I'll cross-check this number, but as of now, we think it is still biased towards down.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to R. Mukundan for closing comments. Over to you, sir.
Thank you, everyone, for joining the call today. While the market conditions remain tepid and challenging, our endeavor is to excel in our operations and continue to focus on what we can do internally. And we will ensure that all our current capacities that come on stream are fully brought on stream, focus on cost optimization and optimization of working capital. Next quarter, we'll be able to give a better update on market conditions as the picture becomes clearer. Thank you all and see you in Q2 FY26.
Thank you. On behalf of Tata Chemicals Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.